today I'm very happy to bring to you another of such stories of Chinmay Kelkar, who is a 2008 mechanical grad from VNIT, and he was an investment banker. Most of the people during their MBAs or even the engineers, they want to be an investment banker. Being a front-end investment banker is a dream for many, including me. I wanted to be, but I could not. And Chinmay was lucky enough or smart enough to get into that kind of a position, and then he left that to start his own investment advisory firm. Now it might appear to be a very strange decision, definitely non-conventional. To some people it might even be a foolish decision. So in today's interview I'm going to ask Chinmay about his story, what he does, what are his thought processes, what is his vision for his company, what have his challenges been, and so on and so forth. so let me welcome Chinmay. Chinmay, if you could just unmute and tell us a little bit about yourself, or I think I need to pin you. Chinmay, are you there?
Yeah, okay. Yeah, I'm there. Am I audible?
Yeah. Let me just pin you. So welcome, Chinmay. I think it's going to be an interesting discussion based on the questions that I have. Chinmay,
sure.
Do you want to add anything to your introduction? This is just an informal kind of a thing. So he also went to IIFT. Chinmay was India's top 5 table tennis players once upon a time. So Chinmay, if you would want to add anything about yourself, welcome and happy to.
Oh, sure. So first of all, thank you, Karthik, for that introduction. And thank you everyone for having me here. Like you rightly said, it's for some, it might appear to be a strange decision moving out of investment banking and starting my own advisory firm. So what I can do is to start off with, give you a basic series of events which actually transpired between these two things, like starting my investment banking career and actually starting my advisory firm after some time, and being one of the youngest advisors to have an advisory setup in the country. Right? So after completing my MBA in 2011, I had joined Edelweiss Capital in their investment banking team, primarily focusing on the technology, media, and telecom space. So the primary responsibility which I had was helping startups. Some of them are unicorns right now, but helping these startups raise their Series A, Series B, round 1, round 2, and so on and so forth, the capital. This actually gave a very unique insight into say how these startups function, or what these founders actually do, right? What is their vision for their company? How do they start from zero and think about creating value? What are the levers which they focus on, and so on and so forth. On the other side, it actually gave a very decent idea about how investors think about investing into startups. Which startups do they invest in and why? And which startups do they ignore and why? And if they decide to invest, how they come about calculating the value for any given startup. I did that for around 2 years, which gave me a very good idea of the entire startup ecosystem. And after that, I moved to L&T. At L&T, I was primarily responsible for handling the strategy and M&A part for their billion-dollar electrical and automation business. And my primary job was to create a 5-year plan and actually make sure that the plan is implemented at the ground level. So moving from an environment where I was working with startups to an environment where I was working in a 60-year-old, very mature business gave a different understanding as to what are the challenges which are faced by the marketing team, the sales team, the operations, the procurement, the quality, and so on and so forth, and how these teams eventually always come together to deliver the results required. The final part of this entire exercise was value unlocking for the L&T group, in which we eventually sold the electrical and automation business to Schneider Electric for around $2 billion. What was also happening during this period is I was always interested in the stock markets. But during my time at Edelweiss, there were a lot of restrictions, since we were working with a lot of listed companies as well, to actually be an investor. When I was at L&T, the working hours were saner. So you got your evenings and your weekends to actually do what you wanted to do. So I started reading. So multiple books, multiple lectures, annual reports, research reports, and whatnot. And after that, after I did that for some time, I decided that now I have a decent personal capital saved up. Why don't I invest this money into the markets and see how well do I do? I have my MBA, I have my CFA, I have a decent industry experience. Let's try this out in the markets as well. And that is how it all actually started.
Yeah, but Chinmay, I think,
Mhm.
sorry to interrupt, but
No problem.
as an investment banker, you must have been making a whole lot of money.
Mhm.
Like, I've heard stories that investment bankers make like 20, 30, 40, 50 lakh as bonuses and all that stuff. And I think probably, you must be doing fairly well in L&T as well. So
Mhm.
what prompted you to start off your own investment advisory firm? In the
Mhm.
sense, it's a struggle. You have to actually start uh, fresh. You have to make others. You have to start getting new customers. It's a different grind altogether. So what prompted this?
So it was not a conscious decision. Like I was saying, once I started investing into the markets, I really found out how lucrative was it, right? When I started doing that, a lot of friends and other acquaintances automatically approached me saying that we want to do this. Why don't you help us out? Right? It is only after I did this for 4 or 5 years, and there were a lot of people who were actually trusting my advice, there being a legal structure around it. That is when it struck me that hang on, I can actually do this for a living. And the difference between making a higher salary and the primary difference which I feel between making a decent salary or having a high profile job versus having your own business is that you are not paid for the time which you put in. You are paid based on the quality of your decisions. In the stock market, if you have to make money by participating in the stock market, it is not the amount of time which you will spend. It is not key. If you work for 8 hours you will get X, and if you work for 16 hours you will get 2X. That doesn't happen. You have to put in a lot of work, but your payout is disproportionate based on the kind of decisions that you make. If you have the ability, if you select the right investments, irrespective of the time investment, the payoff can be huge, and the payoff will be much higher than the any salary or any remuneration that you might get having a professional career. Obviously there is downside to it as well. If the decision goes wrong, you stand to lose a whole lot of it, but there is a higher upside and higher downside. So I really wanted to make that transition, or at least see if I am good enough at that, moving from a time based or a delivery based model to a decision based model where I.
Okay. Fair enough. So, Jimmy, my next question to you is that, there must have been challenges because, when you are working for a big corporate, you are used to some specific set of lifestyle, you
Mhm.
have all your people who help you out with your filing stuff, you have assistants,
Mhm.
when you start afresh as your entrepreneur, you have to, right from setting up your own printer to
Mhm.
talking to everybody, you must have seen a lot of challenges, like all of us entrepreneurs do.
Yeah.
So what were these challenges and how did you deal with them? Can you shed some light?
Yeah. Oh, so there were a lot of challenges. So there are 2 or 3 things which generally happened after I started my business. I started around, I quit my job in May 2018 and started my own firm in June 2008. There were 2 or 3 things which happened. So initially, when I was starting my business, every investor is a big fan of Warren Buffett, honestly. But I really liked, so Warren Buffett used to run this hedge fund in the US between 1956 and 69, and I really liked the structure with which he had created this hedge fund. So I thought, why I'll replicate that in the Indian context as well. So when I had my license and when I had those initial people who were backing me, I had a very simple fee structure that I don't get paid if I don't do any, if I don't deliver. So we had a agreement that up to 10% returns every year, I'll not get paid anything. Whatever I generate over and above 10%, I'll get a 30% profit share of that, which was fair to me and the clients as well, because the clients thought that okay, that fees are charged only after a certain hurdle rate is met. The better he does, the better, the more he gets paid. For me, it was also okay because the returns would be lumpy. In bad markets, I would not make anything, but then there would be these really good phases like we saw last year, in which the fees would be huge, right? So I
So
started
can
with
you
this.
give me an example when you say fees would be huge?
Sure.
Because
So if you just look at it, so I hypothetically, if we started in 2000, if hypothetically I started in 2018, had I retained the same fee structure, say nothing, if I don't deliver more than 10%, I don't get anything. Anything above 10%, I get a 30% profit share. So 2018-19, our returns were, I think, -1%. So I don't get anything. 2019-20, the whole COVID fiasco happened. So our returns were -5%. Again, I don't get anything. 2021, our returns were close to 80 or 90%. So even if you account for the initial losses, our fees would have been 20 to 25% of the AUM which I manage. So suppose if I manage 5 crore rupees, the fee would have been 1.25 crores, approximately, give and take. So what had happened, and so the returns would be lumpy. So every 3 or 4 years, there would be 2 years where I would not make anything. And there would be 1 year where I would more than compensate because of the returns generated. The clients were very happy, and it worked for me as well because I had saved enough money to tide through those bad years. What had happened was in June 2018, I started my business. And within 3 or 4 weeks, there was a clarification from the regulator that advisors will not be allowed to charge a performance fee. Advisors can only charge either a fixed fee, say a 50,000, 1 lakh rupee ka fixed fee, or an AUM based fee like mutual funds do, 1% or 2% of AUM. So when that happened, it was just 3 or 4 weeks that I had started my business. I was yet to sign legal agreements with my clients, right? And this happened. And then, oh my God, this is like the entire business model, which I had spent around 5-6 months planning, completely collapsed. Because now I would never get that spike, right? It would be some small payments, regular payments, but really small payments. And the assets which I was advising on was really did not really justify the fees which I would, the fees which I would get was not really justified. So that within 3 weeks, and I was thinking that had this happened only 3 months back, I would have not quit my job, right? What are the odds of you quitting your job and within 3 months, within a month, something like this happens? But okay, so I did what any normal reasonable guy would do. I thought, okay, if I can only make 2% on fees on my assets, why don't I try to increase the asset base? Why don't I try to and talk to more and more people and get more clients in my advisory account?
Hang on, and you would have made 1 crore in 1 year based on your earlier structure. Now with 2% to make 1 crore, you would need an AUM of 50 crores.
No, so 1 crore is over 3 years, but so
right.
Yes, but around 20 crores, yes.
Wow. So, suddenly the contours of your game changed by just one regulation.
Completely. So then I thought that, okay, abhi 5, instead of 5, I have to manage around 20 crores to justify that. So then I went around people, I called up people I know, started meeting them, saying that, okay, I have started this firm and why don't you let me advise you on a part of your assets, right? But there was a big mismatch because when I had started this firm, it was based on the partnerships of Warren Buffett. And the whole philosophy was not of asset gathering. The business was focused on generating results for your clients. So it was a very low cost structure which I had. And the entire focus, entire energy was not on the marketing part. It was only on how do you deliver returns for your clients. So when I started meeting people, the very common questions which come up was कि कितने research analysts है या office BKC में है कि कोलाबा में है. And when I answered that, no, I am operating out of the bedroom of my Warsaw apartment, they literally thought I was crazy, right? And needless to say, another 3, 4, 5 months went and I was not able to raise any additional capital for fair reasons because the model was not structured that way. And after 6 months of starting my business with high hopes and those glorious numbers in Excel sheets, after 6 months, it was literally a chaos. And to the point where I had started thinking that this is not going to work out. I'll have to go back to work again. But then there were some industry friends of mine whom I had really admired and I had worked with during my previous stints. There were some very close friends of mine whom I also consulted and did a lot of introspection as well. So in the end, I realized that, okay, my best chance of success in this industry is actually doing what I am good at, irrespective of whether I get the fees or not. Despite focusing on gathering more money or convincing more clients, why don't I try and deliver superior performance for the people who have already trusted me with their capital? And if I do that, the existing clients would be happy. And I sincerely hope that they would recommend my services to other people as well. So I thought, let's give this one shot. Let us cut out all the noise. So there is no marketing, no distribution, no pitching to random clients, no being very active on social media. I'll only focus on delivering returns to the clients who have already trusted me with their capital. And fortunately, that worked really well. So till now, I don't have a website. I don't have any active social media handles. But in the last 2.5 years, I've been able to multiply my asset base by a factor of around 25.
Oh.
So that was one of the biggest challenges which I faced when
This is
starting.
one of the myths people say, I don't know, word of the mouth is good till a level, but after that, what? And do people really recommend? Have you seen this at work? Because many times people would want to be secretive, right? I mean, let me make money, let the others not make money. So does that work out for you?
No, so everyone doesn't recommend, but honestly, for me, it is only word of mouth which has worked. In the last 2.5 years, there have hardly been a very few cases where I have actually gone and pitched my services to someone. Most of the clients have come up saying that you manage money for X. We have heard very good things about you. Why don't you do it for us as well? So at least in my experience, and to be honest, there might be a level that beyond say 500 crores or 1000 crores, it might not work, but I'm still some distance away from that level. Once we get to that, then we might have to evaluate different measures.
Interesting. But what changes in your mindset really help you survive? Because I'm sure, if we are in a job mindset, working, so this a company makes some investment, they say this isn't working out, let's kill it, let's not persist with it. And I think that's the key differentiator between an entrepreneur and working for someone else. You don't give up, it's your baby of sort. So
Correct.
Can you tell us a few changes in your mindset that you have made over the last 3, 4, 5 years, and which all the other entrepreneurs here or aspiring entrepreneurs should make, so that they get benefited from your learnings?
So the first thing which I think, and this is a serious mindset change which is required if you are working in a decently high profile job and moving to starting out your own business, is you have to be very comfortable with uncertainty. When I started out, my friends would actually know, and some of them are on this call, that every 3 or 4 months I would panic and call them in the midnight saying ki bhai mera please naukri laga dena agar dhanda doob gaya to, I don't want to starve, right? So because there are so many things which you can't and don't plan for, which come up and seriously impact your business. And the impact is not that 20% performance bonus cut hoga. The impact is ki it will completely, your business is completely at risk. It will kill your 1 year ka revenue. It will kill your 6 months ka profit. And somehow if you are starting up, you have to still be okay with all of that. And you have to still be okay ki yaar challenges to aane hi wale. You cannot model everything in. You cannot factor in all the aspects. Matlab, there is a saying that you will get punched in your mouth from corners which you didn't even know existed in the first place. So you have to be somehow okay with that. That challenges aayenge, you have to be feisty enough to tackle and fight those challenges and still survive and thrive. Second, the other important mindset change was also like as long as it is legal and as long as it is ethical, you have to do whatever it takes to make your business work. So when I was starting out, I was doing it completely on my own. I was an individual guy, individual advisor, right? So even if I had to onboard a client who would say, give me say 15,000 or 20,000 in advisory fees, I had to go get a stamp paper. I had to get that agreement printed, filed, signed, and then courier it to the client, get it back from the client, again scan it, again send it to him, and call him up saying, sir, aapka fees pending hai. And you cannot help but realize ki, yaar, 6 months pehle I was working on a 14,000 crore transaction. Now I am chasing clients for a 10,000 rupee ka fee. And ये क्या level आ गया है मेरा life में? But eventually you realize कि ये आप ही का business है. मतलब glamour और no glamour चलाना तुम ही को है. So as long as it is legal, as long as it is ethical, you have to do whatever it takes. मतलब कुछ भी करना पड़ेगा to make it work. Because you are the only driver for that, right? Nobody else is going to do it for you. So these are the two important things which I feel.
So you have to keep aside your ego and pride and all, and do whatever it takes.
Yes, because rakh lo ego, business band ho jayega to fir kya fayda?
Interesting. Now, so this brings me to different question. See, financial advisory is such a crowded field. I know so many people who tried out multiple things and nothing happens. They say, okay, I'm mutual fund sales. I'm not judging it this way or that, but like everyone here, like having most people get into this field, and it's very difficult to differentiate, right? What is so special about Chinmay that, say, a Karthik who also has an MBA can't say? How do you differentiate? I think people would be asking, and I understand this completely, that in you don't need a differentiator in commodities and stuff, but this is definitely not a commodity kind of a thing, right? So you are differentiated. So how do you differentiate yourself in such a crowded field?
So true, actually. If you look at it from an outside in perspective, there are a lot of people doing this. So you have your legends of Wall Street, the Dalal Street, the Damanis and the Junjunwalas who come on television and give you advice talk about the market in general. There are hedge fund managers, there are portfolio managers, there are investment advisors, there is your local mutual fund distributor. And now there is a whole brigade of WhatsApp, Twitter and Telegram experts who think that stock market में हर साल दुगना तो होना ही चाहिए पैसा, नहीं तो कुछ गलत कर रहे हो आप. So from an outside in perspective, yeah, I agree. There are a lot of people doing this. But the other fact is also true. And I think Nitin Kamath of Zerodha had said this in an interview once, that if you look at any 5-year period, only 1% of the traders are generally profitable. And when I say profitable, it is not making lakhs and crores of rupee. It is about making 1 rupee post brokerage fees and taxes. So only 1% of people who are participating, including professionals and retailers, actually are profitable and make more than 1 rupee on a 5-year, on a cumulative 5-year performance period.
Is that a real stat? I thought. Yeah.
I have no way of verifying it. Nitin Kamath has said it in one of his interviews. Similarly, if you look at investors, after fees, brokerage, taxes, and all the costs put together, it is less than 10% of the people who actually beat the benchmark indices. If the benchmark indices is doing 11 or 12%, whatever the return might be, on a 1-year, 3-year, 5-year period, less than 10, or I think the number is substantially lower than that also, but less than 10% of the people outperform the indices. So if you are a trader and if you are amongst that 1%, or if you are an investor and if you are amongst that 10 or 5%, tab kahan hai competition, right? And if you survive, if you are amongst that, in that bracket, and if you continuously are taking efforts to be there, tab competition nahi hai. We have to realize there are 2 parts. Competition asset gathering में है, लोग आपके पैसे लेके उस पे कमीशन कमाना चाहते हैं, वो धंधे में कंपटीशन है. मार्केट में रिटर्न्स बनाने वाले बिजनेस में कंपटीशन नहीं है, वो बहुत कम लोग कर पाते हैं, right? And it is a stark difference. Actually, one more thing, there is the way in which a stock market, I also feel that the way in which a stock market business is slightly different from any other business is that the dependence on customer validation is lower here. So if I create an FMCG product, or if I am in a tech business and I create an app, even if it is a kick-ass shampoo which I make, but nobody is buying it, or even if it is a killer app and nobody is downloading or paying for it, the chances of my business survival are very slim. So you need customers to go and pay up, right? In the stock market, if you have a strategy, a method, a philosophy which is working, and which is working over a 1-year, 3-year, 5-year period, then it is the market which will reward you, right? The customer validation or people trusting you with their capital and paying fees for it is a cherry on the top. It is not the foundation. The foundation is you doing well in the markets, generating returns and making money because of the returns which you are generating. That is the foundation. Customers trusting you, more and more clients coming in, they are paying you an advisory fee, performance fee, whatever. That is a cherry on the top. That is not the foundation, which is where you can easily differentiate in the stock market.
Wow. So you focus on what is strategically most important part of your business. So we are in the education business, in our business, people make their decisions based on the kind of building the school has, the kind of advertising and school bus services, and the actual education is like comes way below in the pecking order. I thought that that was same about the financial business also, but you seem to think that if you do really well in the core, you would do well, and you're seeing good results there. Okay. Uh, Let me ask you another question, wherein it's a skeptical question, and it might have occurred to a lot of others, and a lot of people have mentioned that to me. See, what is going to happen in the market? Nobody understands. People just claim that they know something, you included. Okay, is what people will say, and then nobody knows what's going to happen. How do you claim to be an expert? Well, you can't. If I tell me what will happen to a stock of say Reliance in the next 1 week, you will not be able to tell me whether it will cross 5% or not. Then my judgment is as good as your judgment. So is there a scope for expertise? Because 95% of the people I see lose money in stocks. They have been swindled. They have been shown big, bade sapne, and then when it comes to deliverance, nothing happens. So, what is your take on this? How do you say that you are an expert, and when everyone else there thinks otherwise?
Uh, this is a very good question, actually, and thank you for asking this. I am somehow not able to recollect the book in which I had read this, but I'll give you an example anyways. Let us take an example of a very highly technical field, say doing a brain surgery, or writing an elaborate code, or building an electric vehicle, or any field which requires a lot of technical expertise. Tomorrow, if I attempt to do any of these things, the chances of success, I know my chances of success, they're close to zero. Somebody who is doing this for say last 10 or 15 years, I know his chances of success, it's closer to 100%, right? If I do this tomorrow, the chances are the same. If I don't practice for the next 5 years and do it after 5 years, again, my chances are the same. The chances of my success are zero. Chances of someone who knows what he is doing in this field is closer to 100%. So it's very easy and clear to demarcate between a expert, not expert, somebody who knows what he is doing, and a complete newbie, right, in highly technical fields. On the other hand, when it comes to the stock markets or any other game which involves probability, the situation is slightly different. I'll give you a example for illustration purpose to highlight the contrast, right? Suppose if we take a complete newbie, and let's take a monkey, for example, and let's take one of the smartest investors in the country, right? The most astute guy, Mr. Rakesh Jhunjhunwala. We have a board on which we list, say, the 500 stocks, which are top 500 stocks in India. We ask the monkey to just throw a dart and select whichever stock the dart hits, essentially. We ask Mr. Jhunjhunwala to recommend his highest conviction bet to us. We take these two stocks and we say कि हम लोग मंडे को देखेंगे, मंडे को जो भी स्टॉक ऊपर जाएगा या जिसका भी स्टॉक ज्यादा रिटर्न देगा, he is the legend and the other guy doesn't know anything, right? So on Monday, since the stock market movements are random over a shorter period of time, there is an approximately 50% chance that the stock selected by this monkey will do better than the stock selected by this legend. And since our minds are typically plagued with a lot of recency bias, we associate a lot of importance with the events which have recently happened. We will say कि Mr. Jhunjhunwala doesn't probably know as much. ये monkey stud investor है, इसको हम लोग सारे पैसे दे देते हैं हमारे. The problem with that is the probability of the monkey winning is 50% only in the shorter term. If you increase the time horizon, to say 1 year, 3 year or 5 years, Mr. Jhunjhunwala will make a killing in the market and the monkey will at best generate average returns. But this is only clear in the longer term. This is in the shorter term, it is very difficult to predict who or understand or assess who is better of the two. So whenever you are talking about stock markets, whenever you are talking about to anyone or trusting your capital with someone, or you have to judge whether somebody expert to koi nahi hota, but he knows what he is doing, right? The only way to do that is to check if the other person has an audited track record of 1 year, 3 years and 5 years. If over a period of 5 years, this guy has consistently done better than the market, then probably he knows what he is doing, right? If the, and if that is not the case, then probably he doesn't know what he is doing. Point is, शॉर्ट टर्म में ये कॉल में से दो लोग अगर बोलेंगे कि हीरो होंडा खरीद लो या हीरो होंडा बेच दो, one of them will be right. That doesn't make the guy an expert. You have to consistently do this over and over and over again to have a 1 year, 3 year, 5 year record of showing that you have actually done something which is better than the market. So I think that is the ultimate filter of that.
Okay. Anyway, I think we are getting too much into finance. So let me just get a step back and ask you, what will be your top 3 advices to someone who wants to start up? And probably for people, because a lot of my friends want to say that, I want to start up, I've saved up enough amount of money and now I don't want to work for anyone and I want to start up. What would your advice to be for such people, 30 something who has money and who has some kind of idea into some business and all? Based on your experience, what would be your top 3 to 5 mantras for that person?
So there is actually a very famous quote from Naval Ravikant, which I think is very, very important in this context. So it goes something like, you can be successful at things which you think is something like a play to you, but is like work for others. Like you can genuinely be successful in things which you really love doing, despite the economic result of your activity. So in my case, when I had started out, for the first 1 year of actually doing this full time was really difficult. The business model was not working. I was not getting more and more. I was not getting clients. I was not getting paid enough to justify the kind of efforts which I was putting in. However, one thing didn't really change was that I really loved the process of investing. So I was still reading a lot of books, still analyzing a lot of charts, still saying कि अच्छा वो book पढ़ लेते हैं, उसका strategy work करेगा कि नहीं करेगा, how can I improve this, how can I reduce the slippages of my trade, so on and so forth. But I really enjoyed the process of investing, and I think that actually helped me tide through that difficult period. Had that not been the case, I would have folded my cards in say 3 or 6 months and gone back to my employer saying ki, I want to come back to work. So loving what you do, like irrespective of the economic outcome, I think is the one thing which will help you tide through difficult times. And difficult times will be there. It will not probably be in year 1, it will be in year 5, but kabhi na kabhi to it will certainly be there. The second point which I can think of is that we are, and I might be, this might not be a popular opinion, but this is what my belief is. So we all hero worship people who have generally bet all their stake on a single event occurring, and that event has occurred and that has taken them into a different orbit altogether. We adore Elon Musk for taking the kind of risk which he does, and more power to him. We need more people like him, right? But when I was starting my business, I was not that much of a risk taker. So I wanted to create a structure in which the chances of my success were not 1 out of 100. They were probably 6 or 7 out of 10. And in this case, there is one mental model from Charlie Munger, which actually helped me a lot. It's called the philosophy of inversion. So if you want to succeed at anything, learn, identify things which will make you miserably fail at that activity, and just don't do those things. So when I looked at a business per se, I would try and look at what would make my business fail miserably. At least try. I couldn't prepare the entire list, of course. But the primary things which came to my mind was, why do founders shut their business? They run out of money probably. They don't get enough customers probably, and so on and so forth. So the idea was to not do any of those things, which will actually increase your probability of success. Because you want to be right at something which you do 6 or 7 out of 10 times, not 1 out of 100 times. And one more thing which I can think of is, which is also not talked about a lot, is that you need a set of people, you need a set of friends or family, which will support you no matter what, right? So because when we are into a business, most of our day or most of our mental space is actually spent in talking to our potential customers, our employees if we have, or somebody who is associated with our business in some way or the other. And most of these people judge us based on the way our business is performing, right? We as founders also constantly judge and criticize ourselves on the way we are performing. If something goes wrong, we feel like killing ourselves. कि ये क्या blunder कर दिया मैंने? Something goes right, we feel on the top of the world, which creates a lot of emotional upheaval. So you need a set of people, be it your wife, be it your family, be it a small set of close friends, whom at the back of your mind you will know, who will stand by you irrespective of how your business performs. So in my case, my wife, my family, my set of 5 or 6 close friends, I somehow knew कि कुछ भी problem होगा तो ये लोग देख लेंगे and will not judge me depending on my business success and failure. This is a very subtle point, but that has given me immense comfort in handling the risks which are normally associated with a business. So I think these are the 2 or 3 things which I can think of.
Any financial suggestions? What kind of financial planning they, because you are from that area. So is there any specific number that you should have in your mind? Okay, I have this much amount of savings which will tide me, or anything of that sort?
Actually, you're asking in case somebody has to start up, what is that number?
Yes.
Is
so what is the cushion? What is the monetary cushion that one should have? So if they, I mean, it would be different for different people based on their lifestyles, but do you have any kind of a thumb rule?
So I can see the risk appetite for everyone is very different. I have known friends who have started with only 6 months of cash in their bank account, and because they thrive in that type of risk taking culture, and they have done really well. They said that if we had 5 years of money, we would have gotten very complacent, right? So I can tell you for myself, when I had started out, I had thought, what is the worst that could happen? Like I said, the law of inversion. I had thought, okay, I should have at least 5 to 7 years of cash cushion. Even if something really bad happens to me, I should not be thrown out of the game, because as it is, you are dealing with the stock market volatility. Add on top of it the business volatility, so it becomes a very volatile business. So even if something bad happens, I should not be thrown out of the game. Good markets will occur at some point of time. The clients will start trusting you. The point is to be in the game till that point happens. That might be 1 year down the line, but it will not necessarily be 1 year down the line. And as the famous saying goes, right, if something wrong has to happen, it will happen. So you have to plan for that. So when I had started out, I had a 5-year cushion with me, saying that, okay, 5 years, even if I don't make a single penny out of this whole exercise, I can still continue my living the way I do. And for what I have also seen is a lot of people try to go all out in their aim. Be it, and since my wife is also a surgeon, I've seen a lot of doctors also do this. When they set up a hospital or when they set up a clinic, when they start their own investment advisory practice, the spend which they do on infrastructure is way beyond their means. So even if there is some slight issue which happens, some slight error in their projections happens, people tend to get desperate, right? People try and sell products to their clients which will help them make commission, instead of thinking whether it is the best product for the client or not. The idea is not never to put yourself in that position. For me, that number was 5 years. For someone, it might be 3 years. Someone, it might be but the ideal number is somewhere between 3 to 5 years. That you have to create that kind of cushion before starting off.
Okay. Before I go to the audience, I just have a last question for you. So, you would have come across varied set of customers, clients, you would have seen their financial decisions and all. So, and you would have studied, you would have read so many books and all these kinds of things, because you'll do it for a living. So what are your top 3 or 5 mantras for financial success? What is it that one should do? And don't tell us bookish knowledge which is freely available. Tell us the real insights, like things that are not talked about openly.
Actually, rather than giving, there is one very common theme which I have seen across all my clients, right? Actually, investing in the markets or creating wealth out of the stock market is really not that difficult. it is the financial services industry partially, and it is the psychology of the clients partially, which does not let that process happen. Somehow, when it comes to the financial market, simplicity always beats esoteric stuff, right? So the first and foremost rule is that you have to invest in things that you understand, right? And even if you don't invest in things that you understand, please avoid things which you don't, right? Tomorrow, if somebody comes up, if given an option between investing in a simple, boring index fund, which will grow at the pace at which this country grows, which is say 6-7% real GDP growth and a 4-5% inflation, something like that, 11-12% of consistent growth, versus a high yield structured product which is which is using currency derivatives and commodity derivatives to help you earn a fixed return. Most of the times the clients are tempted to invest in the second product because they think that it is something esoteric, it is something really novel, and that will actually help them make more money. That doesn't work. It will make money for the fund manager probably, but not for you. So you have to invest in simple stuff, right? Secondly, there is a common perception that I'll allocate 2% of my net worth to the markets, and thus 2% should make me phenomenally rich. And then we take unnecessary risk on the 2%. We buy shares of companies which are almost bankrupt in the hope that कि ये किसी दिन 100 गुना होगा और तब मेरा पैसा बनेगा. People are generally not interested in investing 50 or 60% of their net worth and earning a decent 12, 13, 14% return on their capital. Whereas most of the people who have created wealth over say a 10-year or a 15-year period have done these simple things right. And the third part of it is, of course, to increase the time horizon. Aaj ke din mein, there are so many guys on Twitter, on WhatsApp, on Telegram who are saying ki buy today, buy this today, sell this tomorrow, sell this day after, you will make a quick 10% pop. Yeah, buy these derivative products and in 1 month you will make 30%. Yeah, like I said, ki अगर आपका हर साल पैसा दुगना नहीं हो रहा है तो वो क्राइम है. वॉरेन बफेट नहीं कर पा रहा यार. Who are you to think that it is possible, right? So you have to understand what your limitations are and play games to your strength generally, right? What is your strength? If you are working full time or if you are having a startup of your own, you are not in the market to be the best performer. You are in the market as a part of your asset allocation program, which will help you generate returns which are above the rate of inflation. That is easily possible. That is possible with a very low cost, very low effort, and very low, not low risk, but if you invest over a 5 or a 10-year period, very low risk. But we don't do that. So the mantra, if you call it that way, is to not screw it up. We have 100 options, 100 avenues which are constantly tempting us. कि इसमें कर दो ये जल्दी डबल हो जाएगा, इसमें कर दो ये हो जाएगा. Idea is to keep it simple, keep it long term, and allocate a decent percentage of your net worth.
Okay. So let me open it up for everyone because we have just 15 minutes or so to go. Anyone from the audience, do you have any questions? If you have, just send it to me or via chat and I will ask them, or you can just unmute yourself. In the meanwhile, Chinmay, I also have one question, is that, if it is so easy to make money in the markets, why do we need investment advisors like you?
Actually, it's a very fair question, to be honest. See, what happens is there are two reasons for which you not only need investment advisors, but portfolio managers, hedge funds, any of the category which is licensed by SEBI to do this, right? First is the emotional part. See, generating returns, generating market level returns is fairly easy. You just have to buy the index fund and go to sleep and do nothing about it for the next 5 or 10 years. You will certainly make some money on it. Zyada kam, that will be decided by the market, but you will certainly make some money. How many people are actually able to do that? Or it sounds very simple, but it is not easy. How many people are actually in a position to do that? Most of the people will do this. 6 months, there will be not, the market will not move much, and they'll be like, this doesn't work. Let me do something else. Let me put my money into that share which is almost bankrupt. Shayad wo double ho jayega. So at a preliminary level, investment advisors or any portfolio manager hedge funds is of help to you to help you get those market returns if you are not doing that in the first place, right? if you are doing that, if you are very patient with your investments, if you are already investing in the indexes and generating 10-12% return, then great. You are already better than 75% of the Indian population. For you, investment advisors or portfolio managers might be of help, because to help you generate returns which are slightly better than that on a post-cost, post-fee, post-tax basis, right? So if you select some advisor who is actually able to do that, who has a track record of doing that, then working with him might be able to might help you in generating those few percentage points extra. So if you are in the bottom 75%, the primary role of an advisor is help you keep your emotions in check, help you not do stupid things in the market. If you are in the top 25%, an advisor can actually help you outperform by a few percentage points.
So, Chinmay, there is a question from Mangesh Bakshi sir. He asks, I will ask a boring question, but I hope I get an interesting answer. Said you should not invest in something which you don't understand, and he does not understand Zomato business model. So should one invest in Zomato?
If you don't see, in the stock market, there is no one way of creating wealth, right? So if you don't understand the business, it's okay. There are 5,000 businesses listed in India. You have to understand just a few which will do well for you. If you don't understand, you shouldn't. But since this is a very exciting, this news has been in buzz a lot of these days, I'll just provide my perspective. It's just my opinion, and you should not take it. You should do your own research before acting on it. But the way I look at it is that very few people actually understand the business model of Zomato, right? And whether it will make, it's loss making right now. So whether it's worth 60,000 crores or 1 lakh crore is anybody's guess. The way a lot of, and I've seen this in my tenure at Edelweiss, a way a lot of venture capitalists or institutional investors think about these bets is, if you take a basket approach, what is this essentially? It's a tech business, right? In a tech business is usually a winner take all economy. That if you are a category leader in any particular sub segment of the technology space, and if you are the first guy, there is a good chance that you will eat away all the profits which will come up in that space. We have seen this happen in the US, where tech segment leaders have created enormous wealth for their shareholders. At the same time, not all of the bets which you will take, you have a reasonable chance of assessing which, if you take say 10 or 15 bets, you will not be sure ki Zomato अच्छा करेगा, ki Policy Bazaar, ki Paytm, ki Nykaa. So you can take a basket approach. You can invest a small amount of money in a basket of tech stocks, and some of them will be make you a phenomenal amount of money. A lot of them will do nothing for you. But overall, at a basket level, it will still do well. So this is a strategy which is, obviously, this is not a recommendation. I am an advisor, so I can't recommend things on a Zoom call. But this is an approach which a lot of investors take while evaluating tech companies, tech loss-making companies.
There's a question from Sumit. Do you invest your own? It's like a personal question for you, but do you invest your own money in stocks you recommend, and what proportion of your monthly income do you invest in that?
So I don't have. I think I have around 3 years of cushion which I keep right now, which is purely into safe fixed deposits at ICICI Bank. Apart from that, all my money is invested in the stocks which I recommend.
Okay, so you don't want to give a proportion, percentage, 60%?
Percentage would be around 25% would be in FDs, and 25-30% would be in FDs, and rest 70% will be in the stocks that I recommend.
Okay. So Sumit, I hope that answers your question. Any other questions? Yeah, I think Sumit is unmuting. Yeah, go ahead, Sumit.
No, I didn't want to put Chinmay in a spot. I just wanted to understand what kind of proportions you should put in terms of the convictions that you have in terms of the allocation of wealth and so on. So I think you have answered it.
Okay.
Chinmay.
Yes.
Am I audible?
You're audible.
Yeah. It is said that 100 minus your age should be invested in risky investments like stocks, and rest of it should be invested in safe investments. Like if I'm 55, then 45% of my thing should be in stocks and 55% should be in fixed deposits. Would you like to comment on this?
Sir, honestly, this is one of those investing rules or investing thumb rules, which has been overused to the extent that it is misused now. Honestly, a lot of it, what percentage of your money should be invested in fixed deposits versus risky assets, completely depends on your individual circumstances. And I'll just give you an example. None of this might be true in your case. So if you are 55 years of age and your net worth is say 100 crores, your expenses are 30 lakh rupees a year, then having 45 or 55 crores parked into fixed deposits, which is essentially say, I think more than 100 or 200 years of your expenses, does not make any sense. At the same time, if you are 55 years of age, your net worth is only 1 crore and your expenses are 20 lakh rupees per annum, then parking 45% into equities would be insane. So this is just a thumb rule, which somebody somewhere, say 100 years back, used to prove something. It is not a rule. It is not a physics rule which will always hold true, right? We have to, for any financial planning exercises, it has to be customized to your personal requirement. And this number will be very different depending on the circumstances. I have done financial planning for people who are almost retiring and have recommended to put 90% of their capital in equities or equity plus products, because that was the size of their net worth. At the same time, I've recommended people to put 90% of their portfolio into extremely safe investments, because that was their risk profile generally. So I am not a believer of these thumb rules which have been passed down. We can calculate these things, right? So we don't need thumb rules for that.
Again, another question. Coping with Nagpur life after Mumbai, how does this affect your business?
Actually, I was sorry, Karthik, can you repeat the question, please?
So Sumit says coping with Nagpur life after Mumbai, because I think he's alluding that you are in Nagpur right now.
Yeah.
And how does this affect your business?
I was thinking that it would. I was of the impression that after moving to Nagpur, some of my clients would be reluctant parking capital with me. But honestly, that has not been the experience. So probably because of COVID also. But most of the meetings these days happen on Zoom. So clients are very comfortable doing that. And like I said, I have not yet started approaching people who are completely new and pitching my services to them. So most of the clients who come to me are through word of mouth references. And for them, it doesn't matter where I am located. I have to travel to Mumbai once in a while to actually meet some of my clients. That is true, but it has not impacted my business, at least not as of now.
Okay. I also have another question. You mentioned that you helped some startups raise fund in one of our private conversations. Would you like to tell everyone here about the process of raising funds? Because some of us are at a stage wherein we don't even know anything. So what is the standard process of raising funds? When should one raise funds, and how exactly does it happen?
So just a general disclaimer, not an expert on this topic. I have helped few of my friends and acquaintances raise capital and invested in their startups as well. But the typical process of a startup journey, where it to the stage where it actually raises funds from marquee private equity investors and so on and so forth, is that typically when a startup is founded, it is started based on an idea or a concept, and you probably need some money to get that concept to a stage where it creates a minimum viable product, as they call it. This is the first round of money. Some startups don't require it. Some startups require it to see their idea actually get converted into a product. So this is typically the friends and family round. So you ask your trusted friends and family members to put in small amounts of capital, which ensures minimum dilution and gives you the initial base to create your product in the first place. Once that has happened, once your product is there, then you actually start approaching clients or start approaching customers to create a user case create a use case, okay, that X number of customers have actually tested your product or validated your product. If that is the case, that is when you go for the first round of raising outside capital. And typically, from whatever limited experience I have, this first round of capital typically comes from an industry guy, somebody who belongs to the same industry, somebody who really understands what you are actually doing and is willing to put his money on your company and help you take it to another level. So the level to another orbit generally. So I've seen some of industry leaders invest in one of the companies I work with, which is into satellite imaging. So one of the industry leaders in buying 10% stake of that company and helping them achieve newer levels. Similar cases I've seen in other companies as well. So the next round typically comes from an industry veteran. Once you have a product ready, minimum viable product ready and tested, there will be some industry veteran who takes a liking for that product, will put in significant amount of money and help you scale up. Once you achieve these two stages, then it is a game of what growth can you achieve and what growth can you sustain. Once you have achieved that, then it becomes your Series A, Series B, and all those rounds, which involve the participation of venture capital funds, private equity funds, and so on and so forth. But for someone starting out new, these are typically the first two stages, that raising friends and family round to create a minimum viable product. Once this viable product is ready, have somebody who has an expertise in the industry or the connections in the network in the industry in which you are trying to participate to help you take your product to the next level.
Okay. So that's fair enough. So you start with your friends and family and then go to industry and do that.
For some startups, friends and family is not needed, so that's not mandatory. But yeah.
Guys, we are coming to the end of this time, so I have time only for one question. If there's anyone who wants to ask a question, otherwise, we would want to thank Chinmay for his insightful interview of telling about your journey from being a
Hey Karthik, this is Anand here.
Hey, hi Anand. Yeah.
Hey, hi, thanks. Just a quick one. I know I don't expect a really long answer. So
you can extend for 10 minutes also if needed. Yeah.
Okay, great. Thanks, Karthik. So Chinmay, first of all, congratulations to you on your journey and very successfully pivoting on your philosophy as well. A quick question, in especially in the current market, where you put your hand anywhere and then it gives you 10 or 15% return within 10 days. Okay, in such a market, how do you sell your so-called boring services of the long-term thing, and then I will protect your losses and everything? How do you sell that to the new customer?
So I'll be very honest, it's extremely difficult. It's extremely difficult because if I go out today and say that the long-term expectation, see, a lot of people who approach me now are people who have started, especially people who have started in the last 1 year, have not seen those COVID drawdowns, right? So if I go out and tell people that, okay, the long-term expectation from the equity markets will be, it is a good performance if you generate 18% CAGR after brokerage costs and taxes over a 3, 5, and a 10-year period, then it's very difficult to sell because people have made, say, 60% returns in the last 6 months, right? So it's very difficult. But on the other side, these are the clients which you would also not want, people who have these high expectations, because it is not sustainable. And at the first sight of drawdowns, these are the clients who will run away, who will take their money and go and put it in the next hot thing, right? So you also don't want these clients on board. But to your question, it's very difficult. I have clients who are, in the last 3 or 4 months, there have been situations where I have stopped taking money from clients because I know what their risk profile is, and people actually thinking of selling their valuable stuff and putting money into the market at this point. So I have actually had to counsel them, saying that no, the last 5 months returns are not an indicator of what will happen over the next 5 years. So please don't do that. But it's very difficult to answer your question. Yeah.
Thanks. I think that pretty much answers what you said. Thanks.
I think there was another question from Jayashree. Ma'am, do you have a question? Because I think you were unmute and then I had to mute you because...
No, I think that was by mistake.
Okay, my mistake. Okay, anyone else? So just wait So in the meanwhile, Chinmay, thank you so much. Typically, we've had people from different areas. Every time we start, we want to invite someone. So next time we are going to invite someone from a company called as Health on Way and Meds on Way. So, yeah, am I there?
Yeah, I can hear you.
Sorry, my screen just went black, so I think there's some issue with my computer. But next time we are going to have someone from Health on Way and or Meds on Way. So we want you to join again sometime in the next month towards the end of August, I think the 4th Saturday. But till then, thank you everyone. Thanks a lot, Chinmay, for being such a nice, eloquent speaker. I'm sure the attendees today have learned a lot about how do you plan your financial services business or even personal finance, and how to be conservative and make consistent profits in the longer run. We would have this recording of this video shared on YouTube sometime soon to any of your friends, or a lot of our members have not been able to join, but this video will be available on YouTube as well. So thank you everyone. Stay home, stay safe, and Chinmay, thanks once again.
Thank you so much. Thank you. Bye-bye.
Bye everybody.